There are so many videos on YouTube saying we're going to have a stock market crash again here in June 2020 because of the slew of negative news in the economy currently. So I can't really blame these YouTubers for thinking this, and a lot of this is mainly centered around the global issue and the unemployment really both in the US and on a global scale. There's no doubt that we're in a recession and most likely a global recession here. But why is the stock market approaching all-time highs despite all of this negative news? Today I want to take a different approach and look at the 20 largest companies in the S&P 500 and look at what their future earnings look like. This will give us an idea of what's going on, why the stocks are rallying, and how we can prepare for a potential crash. Remember guys to like this video and hit that subscribe button down below with the bell notification if you're brand new here, if you want to see me do continued updates here on the market, on whether I think it's going to crash or keep going up, and just share my thoughts with you guys. So companies reporting earnings typically report on a quarterly basis. You have Q1, Q2, Q3, and Q4. For most companies, Q1 equates from the period of January to March, Q2 is April to June, Q3 is July to September, and finally Q4 is October to December. But sometimes companies have different fiscal years versus the regular calendar year. But for the purpose of this video, guys, when I refer to quarters, I'm referring to the calendar year Q1 to Q4. So now at this point, as of recording this video, we all know that companies reported their earnings for Q1 of 2020, and we saw what these companies were kind of predicting and thinking for the remainder of 2020. Many of them reported that their business was impacted in Q1, and they expect to see a lot more impact in Q2. And this makes total sense because essentially most of the world was shut down in April and most of May as well. So these businesses, especially those that were reliant on consumers spending, consumers attending their stores and in-person experiences, took massive hits. Now what's also expected is that a lot of these effects are not only going to affect Q2, but they're also going to trickle into Q3 as things slowly start to open back up. Restaurants slowly start to open back up to like max capacity or close to that. Businesses that are consumer facing start to open back up again for retailers and stuff like that. And travel is also something that'll slowly start picking up again with, cruise lines and airplanes and all that stuff. So the effects that we see in Q2 will also kind of trickle into Q3, and I think that's the general sentiment that investors feel as well. Everything I listed right now is known out there in the market, and if you were to ask me, I would say that investors are expecting horrible Q2 numbers from pretty much every business out there, but they expect to see slightly better numbers in Q3 and potentially much better numbers in Q4 and Q1 2021. So really the main attention should be focused on the later quarters, Q4 2020, Q1 2021, because remember the market is forward looking. We're looking 6+ months out. We don't really care what's going to happen in the next few months because that's kind of expected and we know the economy is going to hurt. But if we can see businesses start to recover and we are optimistic about the future of the economy as a whole, then of course as a result company earnings will be good if expected, and as a result stock prices should also be moving up. So what we're going to do in this video is actually go through 20 of the largest S&P 500 companies. That's number 1 all the way to number 20. And we're going to look at these companies step by step, one by one, and we're going to figure out what their estimates look like for the end of 2020 and the beginning of 2021. This will give us a much better idea of what the general sentiment is out there in the market when it comes to these large companies that truly dominate the index. These large companies make up over 35% of the index, so it isn't something you can just completely ignore, especially if you're a stock market investor that both picks individual stocks and invests in ETFs as well. So keep in mind as we go through these charts here that you're going to see a lot of numbers, and you're going to see some red numbers and some green numbers, and typically the green ones are good because it's expecting positive growth, and the red ones of course are expecting declines year over year. So the charts are actually going to be specific to the earnings of the companies. That's another thing to keep in mind. And of course the larger the growth number, the better it is for the business and the more optimistic investors are for that business. And at the end of this video, what we're going to do is tally up how many of these businesses are showing some negative numbers, some negative growth for the end of 2020, that's Q4 2020, and the beginning of 2021, that's Q1 2021. So kicking off our list of 20 stocks here is Microsoft, which is showing strong growth here and is the largest S&P 500 component. Analysts are expecting growth of nearly 20% for this giant, which is extremely bullish and is a big reason why this stock has held up so strong. Apple is next on the list here, and it looks extremely bullish with calendar year Q1 2020 EPS estimated to grow over 40% year over year. So if you're wondering why Apple stock has been moving so much higher despite it being a retail play, a consumer spending play, well, this kind of explains it here because analysts are expecting some massive recovery in 2021. Amazon is next on the list, and again, astronomical growth. Record amounts of earnings is expected as their AWS and e-commerce business continue to dominate in this environment. You may notice that their short-term EPS for the next quarter is expected to go down, and that's because the company did say they'll be investing heavily in the business. And if you're looking for profits, you're going to have to wait for a few quarters for things to stabilize once again after these investments start to pan out. Next is Facebook, and so far it is the weakest here out of the tech giants, with growth expected to be flat to low double digits, and this is expected due to the ad rate cuts in the industry. Honestly, guys, to see any growth in profitability is a strong sign for the business, though, in my opinion, and I think this is actually bullish for Facebook moving forward. Next up, we have GOOG and GOOGL, that's Alphabet, making up the next two components. And similar to Facebook, we get impacted from ad rates here, but Google is more diversified with their Google Cloud platform, for example, which looks to be helping the business. They're also expected to grow at low single digits for the end of 2020 and around 20% growth for Q1 2021. Johnson & Johnson is our first non-tech stock, but again, the same trend continues. Q4 of 2020 looks to have modest single-digit growth, and Q1 2021 looks to see some decent double-digit growth for the business. Next, we have Warren Buffett's business here, Berkshire Hathaway, and it's one that's hurting right now and is the first one to show some weakness in Q4 2020 with slight declines and then a nearly flat expected growth for Q1 2021. This explains why their stock is performing much worse than the others we've gone through thus far, as investors don't really see a lot of upside here in the next year or so. Visa is next on the list, which is our fintech giant, our favorite one on the channel here. And since they are reliant on consumer spending so heavily, they look to see some declines in growth in Q4, but then return to growth back in Q1 2021. Now, this could be a bit too optimistic and will heavily depend on how consumers start spending again and how much pent-up demand there really is. JP Morgan Chase is our first bank on this list, and we know the sector is hurting badly right now, and it's quite obvious why. Earnings are expected to nosedive with no signs of recovery into 2021. We can see it gradually expect to get better as we get into 2021, but growth is completely cut out of the picture here. The banking industry as a whole will see similar results as there's a lot of pressure on them from mortgages to business loans and delinquencies. So I expect 2021 to also be a flat to negative year for these companies. Good old Procter & Gamble is the next up and shows us that they are going to remain fairly strong here with modest growth, but growth nonetheless. This business is still on track to do well for the rest of 2020 and into 2021. United Health is a bit interesting here because we're expected to be essentially flat for Q4 2020, but then in 2021 it's expected to pick back up and have a nice double-digit growth. This stock is also very susceptible to the elections in my opinion, so keep an eye on that as well as we get closer to election season. Next up is Intel, which is our first semiconductor play, and their business is expected to hurt bad for the foreseeable future. A lot of this is probably due to consumers not spending as much on new PCs and Intel processors as a result, but also because competition has heated up severely in the space with Nvidia and AMD taking more market share. We do have Nvidia on this list later on, and we'll see a stark contrast there when it comes to their earnings. But for now, Intel is not looking good. Home Depot is next, which is doing quite well during this crisis as consumers are spending a lot on their home improvement projects. The company is expected to remain strong for 2020 and into 2021, and this is expected as the new normal of work from home embraces the world. MasterCard is our other giant in the fintech space, but unlike Visa, they are expected to see some tiny growth here in Q4, and then like Visa, they're expected to see their business get somewhat back on track in Q1 2021. This again is dependent on consumer spending, but based on the data that MasterCard released recently, we're seeing the spending resume and growing week after week. Verizon is one of the biggest telecom giants in the US and is expected to see some modest declines throughout 2020, but in 2021 it's expected to see some recovery. This is sort of an essential business with the services that they offer, like internet, cell phone. So I could see this company remaining relatively flat here for the remainder of the year and into 2021 as well. Here's the other telecom giant, AT&T, and they are similar to Verizon in their services, but they have more investments in other spaces like Warner Media, which will affect them due to the theater closures and filming halts. They are expected to see double-digit declines for the remainder of 2020 and continued declines in 2021, but I expect some recovery sometime in mid to late 2021. So now here we have Nvidia, which is an absolutely dominating business during these times. The business saw virtually no slowdowns and is expected to continue its accelerated growth into 2021, with 20% plus growth expected in Q4 2020 and Q1 2021. This is in stark contrast to Intel, so it clearly looks like what Intel is going through right now is more of a company-specific issue versus an industry-wide issue. This is one of the best performing stocks of the year and is a company that I absolutely love. Here we have Disney towards the bottom of the list here, and they're absolutely horrible numbers as expected. In fact, their numbers are so bad that there's actually no estimates for the next 2 quarters, as it's expected to fall off a cliff here. But guys, as investors, this was kind of expected because their revenue segments were essentially shut down, but they have slowly started to open back up again now. Calendar year Q4 2020 is expected to see over a 50% decline, but then in Q1 2021, starting off the new year, we expect to see a nice bounce back to growth from the horrible 2020 numbers. The market seems to be very optimistic here on Disney, and they believe they can get back on track by 2021 based on the estimations that we see here. Finally, closing out our top 20 S&P 500 stocks here is Pfizer, and this is the only stock on the list that is expected to see growth in 2020 Q4, followed by a decline in Q1 2021. It's interesting to see this, but there is a lot of negativity right now around Pfizer in general, and this could be a contributing factor as to why analysts have started to downgrade the stock, which could see effects in their earnings in the next year or so. So guys, this was the top 20 list, which again makes up over 35% of the index, and that's over 1/3 of the S&P 500 performance. So it is important to keep track of these businesses. Out of the 40 quarters that we looked at for these stocks, which are Q4 2020 and Q1 2021, there were only 12 quarters expected to have negative growth. Most of the bad performance come from businesses that we expect to be hurting, like banks and media type companies, which are fundamentally affected right now. Like I said, guys, banks of course are hurting from all the mortgage issues, loans, delinquencies, and media companies essentially can't have their in-person experiences right now. So it makes sense why these businesses don't expect to recover as quick as tech plays. And on that note, what's interesting is that tech-related companies are generally expected to hold up quite well here. There will be modest growth, but it is going to be growth nonetheless. Now, there could be arguments being made for certain companies here, like Facebook, for example, which shouldn't be at all-time highs, because even though there is growth expected, it's much lower than previous expectations that were set before the global issue hit. And while that may be true, and while there are some overvalued businesses in this list for sure, from my perspective, the market is flooding into these tech names because right now, any growth is good growth. If you could come out and say that your business in about a year or so can resume back to growth, even if it's very minuscule growth, investors are going to flock to that stock. Investors are going to be extremely optimistic on that stock because a lot of businesses we know are hurting right now. So the ones that are thriving are going to see a lot of money flooding into them. But now as investors, guys, we need to be smart about this and we need to be extremely cautious about this. Everything that we went through today is based on analyst estimates. It's based on what the market is expecting for the end of 2020 and beginning of 2021. Now, this is all going to be reliant on the next earnings season, which starts sometime probably in July. And once we see some of these companies start to report their numbers for Q2 2020 and potentially give us a tone or some guidance for the remainder of 2020 and into 2021, that is when we're going to see some volatility pick back up, in my opinion. If these companies come out and say, things are going as expected, we're moving on track, then what I think will happen is the stock market will probably just continue moving sideways. If they come out and say, things are actually going much better than expected, we expect to recover much sooner than expected, and we're already seeing our profits and revenues pick back up significantly, well then those businesses are probably going to see a bit more money flow into them and the stock price probably move a bit higher. or if they already move up significantly, they may continue moving sideways as well. But now the third scenario, which is very likely and a high possibility here, which we need to pay close attention to, is if businesses come out and say, okay, this is what we expected, but now things aren't looking as optimistic. We're actually thinking that the recovery is going to be slower, and even 2021 may not be a great year for the business. That's when panic could start setting in. Investors could start selling out of their stocks, hedge funds could start liquidating their positions, and we could see another stock market crash. I honestly think that the next earnings report is going to be a massive catalyst here. We already know the economy is struggling. We already know the jobless claims have hit record highs. We already know that unemployment rate is at record highs. That's all known out there in the market. What's unknown is how these businesses are doing right now. We're expecting them to be pretty bad, but we don't know for sure. And what's also unknown is how these businesses expect to do for the remainder of 2020 and into 2021. In summary, really, in my opinion, good news on the next earnings calls could mean that the stocks continue moving sideways or slightly higher here in a slow grind back to all-time highs. Bad news, though, could mean that we're setting ourselves up for another significant stock market crash. Guys, as always, let me know in the comment section down below whether you agree or disagree with me. I hope this insight was useful to you. Make sure to share this video with a friend, because I think this insight here could really open up your eyes to what the stock market really is. Even though the S&P 500 has 500 companies in it, just 20 of them make up 1/3 of the index. So yes, some businesses are hurting, but those businesses are typically very small portions of the index, which don't really move the needle all that much. Guys, as always, I enjoyed making this video, and I hope I was able to share some insight with you. And if I did, hit that like button, hit that subscribe button. But either way, don't forget to invest positively, and I'll see you in the next one. Peace.